Okay, this is the second video that I'm doing in How to Trade, and this one is not about trading. This one is about how you look at your trading system. Now, it's very important to keep a book of your trades with your win to loss ratio. That's so important, and a lot of day traders, a lot of people who are trading for fun don't realize just how important it is to keep some track record of how well you're doing. Not only is it good for you psychologically, when maybe you hit a patch when you don't do very many winning trades, that can be hard. It's important for you as a trader because you need to work out exactly what you're doing in your trading, and I'm going to show you why you have to actually analyze your trading on maybe a monthly basis to actually work out what is the best way for you to trade. Okay, the other day I was looking through the internet and I saw that there was a trading robot for sale. Now, this robot offered a 99% win to loss ratio. So I'm going to put this in here, 99%. And it sounded absolutely excellent. So let's say that you bought that robot, very happy, very excited with it. You put in $1,000 into your account. And what would happen to that $1,000 if you were to make 100 trades? Well, I know because I looked at that robot and I found that the way it makes 99% winning trades is it goes for a very small amount per trade. It just goes for 2 pips. Now, a lot of people think, wow, just 2 pips, it should be able to make that all the time, and it does. It makes lots and lots of winning trades. But, and this is the downside, it uses very often a 200-point stop. Okay, so what that means is that you effectively just go for a 2 pip win, and you're prepared to lose on a single trade 200 points. So how do the figures come out? Well, you can see that if we had a machine like that and a software program that was running that sort of strategy for us, we can see that over 100 trades, if statistics were perfect, you would have one trade that would actually take you for 200 points. The other trades would make you 2 pips each, but you can see that even that robot at the end of the day is only going to give you a loss, and that's not including broker fees. So the cost of getting into a contract is called spread, and that's what you pay your broker. Typically on the euro it's about 2 pips. So if you then look at that, you can see that this isn't going to be a winning strategy. Okay, so why is winning not so important in trading? Well, let me show you. Let's say that you're a swing trader like myself, and you're hitting trades out there at about, say, a 60% win to loss ratio. It's typical for a trader to hit that sort of win-loss ratio on a day trading basis. And let's say that when I take a trade, I go for a profit target which is double my loss. And typically, as I trade on a daily chart, something like the euro will give anywhere between 60 and 90 points. So let's be fair. Let's say that we go for a 70-point profit target on our trades. And because I know the rules of risk and reward, I only want to risk half of what I potentially make. So my risk on a trade would be about 35 points. And let's press the button, and you can see straight away, even though I'm not making 100% winning trades, I'm still making money over 100 trades. And if I was to say trade for $10 a point, I would make $28,000 over 100 trades. Of course, I would lose money, but I would also make money at virtually 4 times the rate at which I lose it. So you can see that being a trader, being a good successful trader, doesn't mean you have to hit 100% winning trades. It doesn't even mean you have to hit 60% winning trades. Okay, so let's take a step back and say I am just a trader that can hit 50% winning trades. But when I take a trade, I try to get 3 times what I'm prepared to risk. So let's say that you're trading something like the pound yen, moves certainly about 90 pips in a day, and you're prepared to risk 30 pips on that trade. Well, you can see there that even though you only get 50% of your trades right, because you're prepared to go for 3 times what you're prepared to lose, you actually make money. Now, the rules get even more interesting, because if you look at someone who's a swing trader and they're trading over weeks or months, and typically as a swing trader, if you're running trades, you might run a trade for something like, say, 2,000 points. Now, many of the swing traders that I know, they use strategies where they might risk 100 or 200 points on a trade. So let's put that in. Let's say that they risk on average 150 pips on a trade, on a swing trade, but let's say that they're only right 20 times out of 100. Well, that's kind of interesting. You can see that these traders, swing traders who are able to find these trades that can run for 2,000 points or more and get in with a 150 point stop loss, are in the position to make money even if they only make 20 winning trades out of 100. So let's say that you're a really super duper swing trader and you're only hitting 10 trades that actually run for 4,000 points, and some of these guys that work for big institutions do run these trades. Let's have a look at what the figures look like. Oh, and if we were using this example, let's say that we use a 300 point stop. Well, that's even more interesting. These guys that go for the big points using a 300 point stop, even though they only get 10 trades right in 100, they still make money. So how many trades would they have to get right to actually just break even? Well, what about if they did 5 trades? Well, they'd lose money then. What about 7 trades? So they only do 7 winning trades out of 100. That means they're getting 93 trades wrong and losing money. Well, they would just about scrape even. But if they're only getting 93 out of 100, then they probably wouldn't be trading anyway. So let's go back to that. I would say good swing traders, they're probably hitting maybe about 30 to 40%. So we'll put in 40%. And you can see the mathematics are quite staggering. Now, the thing is, you're not going to find trades that run for 4,000 points. It's quite rare. So you have to look at how you as a trader want to trade. Some people like to trade every day. Some people like to trade over weeks, months, or even years. And of course, if you're working and don't have the time to be constantly looking at your charts, then a swing trading strategy is possibly what you should be using. Now, me, I like day trading. I also like swing trading, and I'm starting to see real benefits by converting a swing trade, a daily trade, into a weekly, monthly, or even a yearly trade. On my site, I've been talking about the fact that I think that the stock market top is in, and we should see a decline for about 2 years. And I think that that trade could be worth about 6,000 points. Well, I'm already in that trade, and my stop is now to break even, so I can't lose on that trade, and that's my one trade that I'm going to get into. Well, you can see that if I just do one trade this year, then that could make me, or one trade over 2 years, just risking $10 a point, I could make $22,000, which doesn't sound a lot, but there will be plenty of opportunities for me to re-enter that trade and get in and keep selling that market as it continues to decline. In that way, I can actually move my risk per point much higher. So on my first trade, I might get in with a $10 per pip trade. When it comes up again, I'll get in with another $10 and another $10, and I'll keep selling this market as long as it keeps declining. Well, let's say that I build my position over time and I'm trading at $60 a point. You can see how powerful mathematics and using this technique to actually work out the potential that you could make from your trading. You can also see that a winning system offering 99% winning trades and risking a 200, well, we could say risking $10 a pip over 100 trades would actually give us very, very poor results. So let's put that in. So you can quite clearly see that a winning system is not about the number of winning trades you make. It's about the amount you make when you're right and the amount you lose when you're wrong. Well, I hope that this example has given you the correct mindset to the right way to approach trading. And if you want a copy of this simple Excel sheet, just send me an email and I'll send one back to you. Well, thanks a lot for watching, and I hope you stay and watch part 3, which is going to be even more interesting.